Today I'm going to cover two subjects. One is gold. Is it an investment? Is it a good investment? Is it a horrible investment, etc.? The second is the state of the market. For the last month and a half, the market has been, stock market has been, and bond market have been going up and quite a bit. And then the Federal Reserve indicated they're going to stop probably raising rates and are probably gave an indication they're going to start cutting interest rates. So those things sent the market up. And the consensus, the feeling is the market's going up from here. I'm going to unpack that. I'm going to give you some different points of view. And I think you'll like what I've got. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is today is December 19, 2023. Thank you for watching. Okay, I'm going to begin with this piece. This is, I saw this, and it is a piece by a financial guy, Scott Nations, and he is out of Chicago, and he's interviewed, and he has a point of view on gold. And his point of view, and the reason I'm going to play this is because he uses the talking points of the financial advisor industry and of Dave Ramsey. And I'm going to throw Dave Ramsey in because he pounds the table on these same points. And I'm going to give you my perspective. What he is saying is, and you'll hear it, is that gold is a horrible investment. And that for all these following reasons, it's a horrible investment. And it actually, he says, it's underperformed stock market. Well, he cherry-picked his time to say that, but over time, over a long period of time, gold has done better than the stock market. For example, in the background behind him, you'll see this, shows a chart of gold versus the stock market. In the chart behind him, while they're interviewing him, gold actually for 20 years outperformed the stock market by 46%. And, if you look over 100 years or you look over 1,000 years or whatever you want to look, there is a case to be made for gold. Not as the only way to invest money, but as a hedge, as an alternative. I would say, and so if you want the traditional financial advisor talking points, you like finding a way to discredit gold, go ahead and listen to him. And by the way, when you get to Dave Ramsey, who does the same talking points, Dave Ramsey has a huge bias against gold. Again, he states the same reasons, but you have to look at Scott Nations and Dave Ramsey and traditional financial advisors, and you got to get behind the talking points and ask yourself, why are they saying this? Because there's a lot of evidence that their points don't make sense. And the reason, in my opinion, is that Dave Ramsey plays to his audience, which is the financial advisor industry. Those are the people who are his customers, not you, the public. He entertains you. He says some interesting things, but he doesn't make money on what he says to you. He makes money by selling your name as a lead to 3 financial advisors. If you call in and want to be referred to one of his endorsed local providers, he will sell your name for, the last I heard, was $180 per name per advisor, and he sells it to 3. So he's making over $500 for every person that calls in that wants a referral. That's how he makes his money. Millions, maybe tens of millions. He makes a lot of money selling leads to endorse local providers. In the financial industry, the people he sells your name to are people who work on commission. I have not met and do not know of any advisor with Dave Ramsey organization that does it any other than this. They take commissions. They use commission products. Where does that commission come from? It comes out of your money. So he can sell you a product. And with gold, there are no commissions. These are not fiduciary type advisors who work on advisory fee. They're commission salespeople who represent their company and want to receive a commission by selling something. So I object to the entire Dave Ramsey model, and I also object to the concept of commission sales with financial products. Now, when you buy a car or furniture or whatever, you expect, even insurance, you expect a person to receive a commission. That's normal. They are commission salespeople. But when you get into the financial services industry, you get into investments, if someone gets a commission, that money's coming out of your money. And that's, generally in the industry is becoming more and more frowned upon as a method to acquire financial advice. So that's my pitch on Dave Ramsey. And it sounds like through Scott Nations, he's kind of got the same objection. And here's my point on precious metals and gold, or gold and silver, is that I've made it very clear I have a bias. I buy for myself. I have bought for a long, long time, 30 years or more. I have bought gold and silver, and my preference is silver. And the reason I do it, it's not an investment. So he picks on this point. He knows better. He picks on this point, it's a bad investment. But it's not an investment. It never has been an investment. Now, you may look at it and say, I doubled my money or whatever, and think of it like that, but that's not what it is. Gold and silver, or any precious metal, is a hedge against inflation, number one, and number two, I think more importantly for me, it's a hedge against the decline or the collapse of the paper currency system. We are in a paper currency system. It's backed by nothing. It may be at one time, a long, long time ago, when it was much, much lower value. There is about, 8,000 tons of gold in Fort Knox. But over the past many, many years, I'm going to say 20, I don't know, maybe it's closer to 50 years, they have not added any gold to Fort Knox. None that I know of. But how much printing has gone on in the last 20 to 50 years? Tons of printing. So all you have is paper. Paper currency is called fiat currency. And it has become worth less and less and less and less. It's worth no more than 6 cents on the dollar. No more than 6 cents on the dollar compared to what it was when the Federal Reserve came into existence in 1913. Some I've seen, maybe it's 4 cents, but at least 6. Not worth more than that. Why? Because it's printing and printing and printing with no more gold behind it. So gold, if you own it, that it has intrinsic value. If you go back in history, all the way back to the Egyptian culture, you could say, what is that, 4,000 years? Maybe you could even say 5,000, but at least 4,000 years, it has always been a means of exchange. It has always held its value, and it has intrinsic value. And so that's why I buy it. And I hope I never need to use it. But I do not buy the argument just because it doesn't pay a dividend or pay a commission or whatever. I don't subscribe to that. So anyway, I'm going to let you listen to this. I wanted to just give you my background on it. And when you look at gold or silver, I hope that you think in terms of this has intrinsic value and it is protection. It's an insurance policy. against the decline and perhaps the eventual collapse of paper currency. So take a listen to this piece from Scott Nations.
First of all, there's gold that you can see in your portfolio and trade it with the click of a mouse. And then there's the kind of gold that you get from your grandmother for Christmas, maybe. Which one is the better investment?
Well, I'm not a big fan of gold as an investment at all, but the bullion, the sort of thing you might buy from Costco, is a particularly horrible investment thesis. It's essentially a shiny rock, an expensive doorstop, call it what you will. It doesn't pay dividends or interest, and in fact, you have to pay to store it and insure it. And as Warren Buffett likes to point out, it's crazy that we dig gold out of the ground and then bury it in a vault in the ground. And in a market like today, with short-term interest rates above 5%, the opportunity cost of owning gold is substantial. And finally, if you want to invest your money, then stocks are a great way to do it. Over the past 100 years, the Dow Jones Industrial Average has generated a return that is 6.5 times that of spot gold. So I'm not a big fan of gold, and in physical form, it's a particularly bad investment.
Okay, so I will just say right now, I see some of the commercials that my dad's watching and my father-in-law is watching that say, hey, look, gold can be a great hedge to your equities investment. You don't see it as even a good protection. Okay, I'm going to put my money in stock, but I'm also going to own some gold as another resort and to diversify my portfolio.
Diversification is wonderful. It's actually the only free lunch on Wall Street. But the way for most people to diversify is have 60 to 70% of their portfolio in equities and the balance in fixed income.
Okay, now I want to play a piece. I'm going to jump over into the stock market, what's going on with the stock market. And this is an interesting piece. This is kind of the more bearish view. I'm going to give you some bullish views on it, but this is more the bearish view. And this guy's talking about he's being interviewed. So he talks about that millionaire investors. Okay, these are people who have $1 million or more to invest. And he shows the statistics of where they are on stocks, how much of their money is in bonds or money market or stocks and so forth. And he makes the case for the fact that millionaire investors are bearish right now, even though the market has taken off for the last 6 weeks. They're bearish on stocks. And the consensus, and you'll hear it, I'm going to play you some pieces. The consensus is that get in, the market's taking off. I don't know if it is, but that's what the pundits are saying. So he's saying millionaire investors aren't buying into this momentum, this FOMO thinking, fear of missing out. And he says that they are being very cautious right now. Isn't that interesting? So you'll hear the differing points of view, but so take a listen to this.
Welcome back. The results of CNBC's latest Millionaire Investor Survey are in, and while the group feels bullish about future returns, there's one thing weighing on sentiment, and Robert Frank is here to tell us what it is. Robert?
Well, John, millionaires still holding a lot of cash, and they're worried about Washington. The CNBC Millionaire Survey, that's where we poll those with investable assets of at least $1 million. They found that most millionaire investors say the S&P will be up at least 5% next year. Over 20% expect double-digit gains in 2024, and 21% expect markets to be flat. They plan to keep about 40% of their portfolio in stocks next year, 18% in fixed income, and still keep a lot in cash, with 25% of their investments held in short-term money markets and cash equivalents. Their favorite sectors for stocks next year are tech and financials. When it comes to the overall economy, millionaires are a bit more bearish. 42% say the economy will be weaker or much weaker next year. Only 30% say it will be stronger. The biggest risk to the economy next year, they say, is government dysfunction. Inflation's still also a concern about the economy, along with national debt. And when it comes to the Fed, only 27% see a rate cut in the first half of next year. 40% say the second half of 2024, and more than a third of millionaires say the Fed won't cut rates until 2025 or later. And John, given that Fed pivot on Wednesday, obviously if we took that poll today, it'd probably be a little bit different. But interesting how going into this rally, millionaire investors who, after all, own 85% or more of individually held stocks, they were not positioned for a market rally. They're holding a lot of cash and planning to be defensive next year.
So this is a piece from Ritholtz's Josh Brown. He's on CNBC quite a bit. And he says he's on the other side. He's making the case for get into the market. Inflation is down. The Fed is loosening up their monetary policy, and stocks are moving up. Get invested. We've got a big bull market ahead of us. So in that, this is the traditional financial advisor, Wall Street person who's pounding the table, invest, invest, invest. Maybe he's right. We don't know. But the mantra is usually about the same. There's never any caution about bear markets. But I subscribe right now to the idea that you should be invested. But I would say with caution after we get to, and I'll play you another piece, as we get to the Fed cuts, then I would be start to change that position. With our investing model, we got into the market in after 4 market days. On the 4th market day, we got into the market in November. So this is the first week of November we got invested. So we stayed invested throughout November, did very well, obviously. Most everyone did well. But we had been out of the market during the decline, the 3-month decline before. We'd been out of the market 6 of those weeks. So we're still invested. And we will stay invested until we get an indication that the market starts to turn, and then we'll get out. That's our methodology. Okay, so take a listen to Josh Brown.
Ritholtz Wealth Management.
I'm crying. I have tears in my eyes.
What is your assessment here now? What does this mean for stocks moving forward? Let's just take it from there.
Some stocks are overvalued, but on the whole, the asset class, not overvalued. That's the only thing Jeff just spoke for 30 minutes. The only thing I disagree with him, the blanket statement that stocks are overvalued. You can buy small caps for 12 times forward earnings. You can buy mid caps for 13 or 14 times forward earnings. You can buy large cap basic materials 9 times earnings. I feel like there's a lot you could be doing away from the S&P 50. Most of which are tech, consumer discretionary. There's a lot you could be doing where you are not overpaying for stocks, especially if you want to take the Fed at their word that we're going into a cutting cycle. I categorically disagree. Money markets were the trade of the year. $6 trillion in money markets right now. We don't need it all, quote unquote, all to go into stocks. If any meaningful portion of that $6 trillion goes into stocks, doesn't have to go into the SPY ETF. It can go into dividend aristocrats. Look at them. NOBL. Look at the way they're treating the VIG, Vanguard dividend. This is where the money is flowing right now because everybody understands this. You could buy stocks without buying the 7 stocks, and that's the trade right now. I think that trade carries us through. I have tears in my eyes. This is like the end of a romantic comedy. Everything fell into place. We're going out with a VIX at 12. What else do you want? We have vanquished. Who's laughing? Liz? We'll see you in a minute. We have vanquished 9% inflation. We did it. We did it without a single person losing a job. Please understand that. We just printed plus 199,000 new jobs last month, and the war on inflation has been won. VIX at 12, stocks cheap enough to buy. All of the most widely held stocks in America having massive double digits, in some case triple digit rallies off the lows. Plus, we averted a potential banking crisis. What else could you have asked for out of 2023? I don't know.
So this next piece is interesting. It also makes a case for the fact that people are not jumping in to the market. $6 trillion is sitting on the sidelines. He makes the case for, I think it's like 5.8 trillion in money market funds. So that money, if any significant portion of that money comes into equities, it is going to serve as a catalyst to push the market up. But what he's saying is the money is not moving that much into equities right now. And he shows the historical pattern during 4 markets like this in history, and shows that money doesn't come into the market that quickly when it's been on the sidelines. And I thought that was interesting. Even though some are making the case for get into the market, the bigger money, and the historical pattern doesn't show that that's actually the case. But take a listen to what he has to say.
Actually, investors are stashing nearly $6 trillion in money market funds as high interest rates gave those instruments better returns in the stock market. But if borrowing costs fall in 2024, will that hoard of cash make its way back into equities and push the markets higher? Our next guest says history could be telling otherwise. Let's bring in Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to have you with us. You actually wrote about this in August. I thought this was really interesting, the chart, because you find that it's not now. People aren't going to be cycling back into equities right now.
That's the message history has told us. When you look at the previous 4 major peaks in money market assets, they really did not start to roll over until we were well into the rate cutting cycle. I'm still getting used to saying rate cuts after the last year here, but that's really been the trend in history. And I don't see any slowdown. If you look just at November, fund flows into money market assets, you had $200 billion going into money market assets despite rates coming down. So that trend is still up for now. I do think that you'll have some flows coming into equity markets, of course, and support the market, especially a lot of offsides positioning. There's confidence in this market as well. And I think we've seen the highs for interest rates. So supportive for the market, but I don't think it's worth holding your breath for an imminent trend change here with fund flows into money markets.
Now, I'm going to play a piece here, again, CNBC, with Liz Young. She is the chief equity strategist for SoFi. And so I kind of agree with her thinking more. She says that stay invested until the first rate cut. So if there is a rate cut, she sees that as actually more of a cautionary sign. In other words, for them to do a rate cut, what this means is there has to be some kind of trouble in the economy. Things are slowing down and they need to stimulate the market, which would mean a rate cut. So she sees stay, and I've seen this with others. I played a piece last week with Felix Zuloff, and he said into the first quarter, probably from now through the first quarter or into the first quarter, things look pretty bullish. And that's kind of matches what I think what she's saying. So that makes sense to me. But beyond that, for the rest of 2024, I would put a big caution mark. And she even says, after that first cut, then get more nervous. I think those were her words. So I tend to agree with that. I think there's a time to be bullish, and there's a time not to be, and that's during a period of decline. But anyway, listen to this piece by where they interview Liz Young.
These final moments. Liz Young, to you first. To the Bears. Throw caution to the. Throw caution. I didn't say you. Throw caution to the wind now, or what?
First of all, I'm excited to be in the market zone. I never get to do this.
All right, well, welcome.
I think you can throw caution to the wind for a little while. Things change today, and Gunlock used the word pivot. We moved to a different part of the conversation, right? We went from, they were talking about maybe hiking. Now they've basically declared that's over. We're talking about considering when we should be able to cut. Now, the idea of the market pulling cuts forward, though, I think is precarious, right? We continue to pull them forward. We don't have a lot of time between now and March, and the Fed likes to foreshadow things really far in the future. First we talk about cutting, then we actually cut, right? So they need a little more time than that. I think pulling it forward is dangerous. The other thing that I know I've mentioned on this program is that the period between the last hike and the first cut is usually okay. So I think you can, for the time being, jump into this rally, let it run, let the clock run on it. But as soon as that first cut comes into view, you get more nervous.
Okay, hopefully this was helpful, and thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.